balance sheet of the bankings, and then we will, if we still have time left, we will talk about the risk management. Okay, the risk management of the banking system. Okay, let's see. This is the outlines of the talks. Before I moving to the outlines of the talk, I would like to emphasize that in these modules, we will mainly focus about the role of the financial intermediaries or the role of the commercial banks on the financial system. Okay, the reason why we study the asymmetric information is because of the financial institution. Asymmetric information is the main reason, why we need financial institutions in our economy. Okay, in our economy. So we need to examine the structures of the balance sheet and the structures of the business of the commercial bank. Now, let's move on to this one. When we talk about the balance sheets of any firms in the world, we can use these equations to explain the sources of funds and the uses of funds. Okay, the sources of funds and the uses of funds. You can see that total liabilities and capitals. You can call capital equity. Sometimes you can call capitals net worth. Okay, because net worth is the difference between the assets and the liabilities. Liabilities and equities are source of funds. Okay, are source of funds, and the firms can use these funds to obtain the asset. Okay, they can use these funds to obtain the asset. In the context of the financial intermediaries or commercial bank, I will use the word commercial bank. It would be simple, will be easier when I talk about the financial intermediaries. When we talk about the commercial bank, you can see that the source of funds can be from the depositors. Okay, which will be in the forms of the liabilities to the commercial banks, and the capital, which is the owner's money. Okay, the owner's monies of the commercial banks, and these are assets. Can you give me the example of the asset of the commercial bank, please? It seems to me that with few people we can run the class more efficient. Okay, what is the example? Can you give me the example of assets, please? In terms of the commercial banks, for the commercial banks, what is the asset of the commercial banks? Please. We talk. Sorry, please. Cash. Correct. Cash. Sorry. Okay. Factory, buildings. Correct. Buildings. And the most important one that differentiate the balance sheets of the commercial banks to other firms is loan, mortgage loan. Okay, mortgage loan. And banks can use the funds to invest in the securities market. And they can also invest in the market for debts too. Okay, so these are uses of funds. Okay, the most important one is the mortgage loans. Mortgage loans. Okay, now let's see. And these are answers for my questions. Okay, now let's first start from the liabilities. On the liability side of the commercial banks is the deposit. Okay, the deposit from depositors. When people deposit their money into the bank, that money is gonna be the asset of the depositors, and it will be the liabilities to the commercial bank. Okay, we can write it down as the checkable deposit. When you engage in the business transaction, you can use a checkable deposit rather than the cash to finance or to pay your transaction because it is more efficient and it is easier. Because sometimes when you need to transfer the money, let's say 500,000 or 300,000, sometimes you do check about deposit. It would be better off than using the cash. Okay, and we also have the clearing house. Each bank will have their own clearing house. They will check whether that check is valid or not to validate the checks whether it can be checkable or not. Okay. If you watch the movie Catch Me If You Can, have you ever watched that movie? Catch Me If You Can. Do you know Catch Me If You Can? Catch Me If You Can is a movie. If you have time, I think you should spend time on that movie because the actors, okay, the main characters in that movies, um, they just engage in some fraudulent activities because he create his own check and use his own checks uh, to obtain the transaction, and they also and he's also a pilot, and when he engaged in the transaction in this state, he just pay for the transaction with checks, and after that he fly to other state and also replicate these strategies. And so you can see that for this one, checkable deposit is a very efficient way and convenient way in terms of doing the transaction. The next one is the capitals. And examples of the capitals, which is pretty straightforward, is the retained earnings. Okay, retained earnings on new equity. In fact, for the capitals of the banks, we also have the capital called Tier 1 and Tier 2. Tier 1 and Tier 2. Why we call it Tier 1 and Tier 2? Let's see this one. Okay. This is the example that I use the most in the class when I talk about the commercial bank. This is the asset side. This is the liability side of the commercial bank. This one is the equity, or sometimes, or we can call it net worth. Okay, we can call it net worth. And the examples of the items in the capitals or in the equity size here can be the capital that we call tier 1 capital and tier 2 capitals. Okay, the roles of these capitals is like a financial cushion. Financial cushion of what? Financial cushion for the bank. And this financial cushion will help the banks when the value of the assets here goes down. Okay, this one is fixed because it is the liabilities. Depositor deposit the money here, so this one cannot be changed. It can be changed only the case that the depositor just deposit withdraw the money. Okay, and for this one, when the value of the assets go down, the value of the equity go down. Suppose that this is our financial cushion. Okay, this in the shaded area, this is our financial cushion. It can be the tier 1 and tier 2 here. And this is the part that is the monies of the owner of the bank. In fact, all of these parts are the monies of the owner of the bank. But for this one, we just allocate it to be the tier 1 and tier 2 capitals. And we call it the financial cushion. When the value of the assets goes down, the value of the equity here also goes down. If you allocate this fraction enough, you will see that we will have the values here go down, but it is still in this shaded area. Okay, so this one, they are tier 1 and tier 2 capital. It's working out the Q from the price go down here. Okay, so this is the functions of the capitals. And for this one, we have the regulation. For this, we call it Basel. Okay, Basel is like a the policy that we call it the macro prudential policy. policy. This one is from the central bank. Okay, this one is from this policy is come from the central banks. For example, the central banks may enforce the commercial bank to allocate these fractions as 7%, of the NPL here. Okay, this for the examples. You need to allocate some money for the NPL. If the NPL here you cannot collect the money back, right? The value of the asset here goes down, and the values of your network will go down too. But it is still in the area that is still acceptable. Okay, acceptable. Okay, this is the functions of the capital. Okay, even though it is the money of the owner of the commercial bank, it still has some function. Okay, it still has some function. Okay, financial fusion. Now let's get back to our lecture. And where are your friends? It seems to me that your friends um, go out and never get back to the class. Okay, next time I think we shouldn't have a break, but I should let you go before 11:30. Otherwise, you will not get back to the class. Okay, now let's see. The next one is the one that I just asked you to give me the examples. Okay, this is the examples of asset. We have reserve, we have cash, we have deposit. But this kind of deposit is the deposit at other banks. You can use the money. You now, you I when I call you, I mean you guys now are the managers of the commercial banks. Okay, you guys now are the managers of the commercial banks. You can deposit the money in other banks, and that deposit will be your asset too. The next one is the securities. The securities here can be both equity, can be the debt securities, or it can be the derivatives. Okay, the derivatives. The financial firms managers or the managers of the commercial bank can use the derivatives such as the futures, options to hedge the risk in the balance sheet. And I think you will see in a few minutes that when we talk about the value of the asset, liability, and equity in the balance sheet of the commercial bank, the values of all of these items are really sensitive to the changes in the interest rate. Okay, when the interest rate change, or when we have the changes in the interest rate, that changes will directly affect the values of the asset, liabilities, and the equities of the commercial banks, especially the value of the asset side of the commercial bank. We call this situation the interest rate risk. Okay, the interest rate risk, the risk from changes in the interest rate. Okay, now let's see. This is the core business. This is the core business of the commercial bank. The commercial banks borrow short-term fund and lends to the long-term transaction. Short-term funds are the deposit from depositor. Depositor can withdraw the money on a daily basis. So that's why the liability size of the commercial banks are short terms. Okay, are short terms. But when we talk about the asset side, the example that I use in the class is the mortgage loans. Okay, mortgage loans, which are loans, which sorry, with normally the mortgage loans are long-term loans. So that's why on the asset side of the bank, we have the long-term asset. We have the long-term asset. As you can see for this one, we have the issue here. The issue arises in this context is the mismatch, okay? The maturity mismatch between the asset and the liabilities. This is why we always call that the structures of the bank is fragile. Okay, it is really fragile because banks borrow short and then long. It is really fragile in terms of the maturity of asset and liability. Now, let's see the hypothetical balance sheet of the commercial bank. A here is a depositor. Okay, we have banks here, and we also have the business. Okay, now let's see. Uh, I would like to draw your attention to these ciphers, the commercial bank. For the simplicity, I will write only the assets and the liabilities. I will not write down the equity, okay? So for this bank, asset equal only liability. The equity is set to zero, okay? The equity is set to zero. You can see for this one, suppose that Mr. A deposit the money in terms of the checkable deposit, which cost $100 or 100 baht for simplicity, 100 baht. You see that the checkable deposit here appear on the liability side of the bank, and at the same time, it also have here as the loan 100. In fact, before it is loan, it should be cash on the asset side 100. Okay, cash on the asset side 100, and after that, bank just transfer or bank transform the cash into the loan by lend 100 to the business here on the right hand side, the business here. So bank loan here, from cash we will write it down as loan cost 100, and bank loans here will appear on the liability side of the business firm, okay, of the business firm. And in the same time, suppose that this one is just for the examples, so I assume. And at the same time, suppose that this business just deposit the money in terms of the checkable deposit in some bank. The checkable deposit here will be on the asset side of the business firm, okay, in the business firm, and it will be the liability side of the commercial bank. So you may observe that I write checkable deposit with Q because the textbook that I use in this lecture, I use it like a Canadian version. So that's why it is checkable deposit with Q. Okay. So this is just a big pictures of the business of the banks and business firms, and you can see that there is a link between the business and the bank. Okay. Remember that the liability side of the commercial bank is short term and the asset side is long term. Okay, let's see this one first. Okay, I think this one you can read from the slide. Okay, I will read it now. Bank is a business of making a profit, okay, for its shareholder. So you can see that the objective of the bank is to maximize the profit, okay, is to maximize the profit like other business in the world. When you run a business, your main objective should be to maximize the profit, okay, and this profit will benefit to shareholders because when you run business and when you have profit, you will have lots of retained earning, and when you have large retained earning, this will directly affect the values of your share, and so the shareholders will benefit from this one. And the creations of deposit occur as a byproduct of bank financing decision. You can see that the deposit here in these transactions can occur, right? But when we have the deposit in the bank, it means that that money will be used in some other transaction, such as making loan, such as buying some securities. Okay. Okay. This one, I think this one I have talked already. I will move to this one. Okay. Now let's look at this one. This one is just more complicated version of the bank. I think I should start from this one first. Okay, this one is just a normal balance sheet that I just assume that asset equal liabilities. Okay, we have 100 for checkable deposit, and at the same time we have 100 in reserve. This means that this bank just reserve 100 for its reserve on the asset side. Okay, on the asset side. So that's why reserves here is equal to the value of checkable deposit. Suppose that the central bank implement the policies. We call this policy the required reserve policy. That is, the commercial banks has to keep 10% or keep some fraction with the bank. And bank can use the rest of the fund to make loan. Okay, can use the rest of the fund to make loan. Now let's see what happened with the balance sheet. This one, okay, on the right hand side we have 100 baht of checkable deposit, and for 100, because this bank has to collect or have to keep 10% of 100, you will have the design reserve equal 10 baht. Okay, 10 baht here come from 10% of 100, 10% of 100. And we also have the excess reserve equal 90 baht. In total, on your asset side, you will have 90 baht plus 10 baht. So you will end up with 100 in total. And because this is the balance sheet, the value on the asset side should be equal to the value on the liability side. Okay, this is pretty straightforward. Okay, now let's see what happened next. For this diagram and for this balance sheet, sorry, I would like to show you how banks obtain the profit. Okay, you can see for this one. And for this one, suppose that we have the 90 baht here are the excess reserve. Suppose that bank make loans 90 baht. Okay, bank use out of this one, use of our 90 baht to make loan, and bank charge the interest rate on this loan 10%. So for this one, bank will obtain 10% of 90 baht, which is equal to 9 baht. 9 baht should be the revenues. Okay, should be the revenues of the commercial bank. Okay, because this one is an example. In the real world, checkable deposit will not pay the interest rate, but this one just for the hypothetical example. Suppose that this bank also pay the checkable deposit with the interest rate of 5%. So the depositor will deposit Mr. A. Mr. A will deposit the money in the form of checkable deposit. Will receive 5% of 100, which is equal to 5 baht. Okay, 5 baht is the cost of the bank, because bank need to pay the depositor 5 baht. Suppose that this bank, the manager has to pay the management cost equal to 2 baht. You will see from this transaction we have revenues equal to 9 baht minus 5 plus 2 minus 5 plus 2. So the expense here should be 7 baht. As a result of this, bank earned the difference from the interest rate that obtained from the loan, right? That is subtract from the interest rate that paid to the depositors and the management cost. So this is the profit of the bank, 2 baht. Bank earn the difference from the interest rate. Okay, banks earn the difference from the interest rate plus the management cost here, which is also the cost. Okay, this is how bank obtain the profit. Because this is the hypothetical example, so you see that it is really is easy to understand, but in realities, when you deal with the balance sheet of the commercial bank, it will be extremely complicated because you will have this one on the excess reserve. When the bank makes loan, you have a lot of assets with different maturities, with different types of risk, and you have to think about the models that can capture the value of that kind of asset. So it is not a cup of tea of that when you have to deal with the bank in the real world. But this one I just use for the example, so it is very too easy, I think. Okay, now let's see. This is the first topic of the banking management, which is the liquidity management. You can read it from the textbook that I will give you. I think after this class, I will post the link to the textbook. But for this class, I think I will use the example to explain. If you understand the key idea of this one, I think that is all. Okay, now let's see. For this bank, suppose that we have the situation called deposit outflow. What is deposit outflow? Deposit outflow is the situations in which the depositor withdraw their money. Okay, withdraw their money. So let's see for this one. This is the more complicated versions of the balance sheet. On the liability side of the commercial bank, we have deposit equal 100, we have capital equal 10. On the asset side, we have reserve equal 20 million, okay, 20 million, and we have loans equal 80 million. And these banks also allocate the money to buy the securities. It can be the equity, it can be the debt securities equal 10 million. If you compute or if you combine 20, 80, and 10, you will end up with 110, right? 110 and 10. And also on the right hand side or on the liability side, you will have 110 too. Because this one is a balance sheet, the value of both sides should be balanced. Okay, should be balanced. Okay, what happened next? Suppose that we have the situation called deposit outflow. 10 million. That is, people who are depositors withdraw the monies equal 10 million from this bank. What will happen? What will affect to what will be the effects of the deposit outflow to this bank? You can see from this deposit. Before this one, we have deposit equal 100 million. Okay. After deposit outflow, we have only 90 million left in the pocket of the banks because this one depositor withdraw the money, 10 million. This is what happened on the liability side. And what's next? On the asset side, you can see from the previous slide that we have loans equal 80 million. Can we change the value of the loan? If you were bank managers, can you change the values of the loans, or will you change the value of the loans? Will you reduce the amount of loan or not? If you were bank managers, will you do that? Will you do that? If you do that, you will lose your customers. You will not do that. So that's why loans here is fixed. Loans are fixed here. Loan items are fixed. Okay, the values is fixed at 80 million. And how about security? 10 million. Will you sell the security for in this situation when we have deposit outflow? When you buy security, it means that you put your money into the market in the forms of the equity, in the forms of the corporate bond. I think you guys know that the corporate bond or the debt securities have the maturity, right? If you sell the securities before the maturities, you will you will be likely to experience the capital loss if the interest rate goes up, right? So this one, the value of the securities here is fixed. We have the last one left, which is the reserve. Okay, which is the reserve. Reserve here is in the forms of cash or money. Okay, so when we have the deposit outflow, you will see that the value here is reduced by 10 million, and the reserves here from 20 million goes down to 10 million. Okay, go down to 10 million. This one equal 10. Sorry, this one equal 20 million minus 10 million. Okay, minus 10 million. This is the situation. Sorry, this is the effect from the first point here. Okay, deposit outflow 10 million, and it's likely to affect the balance sheet like in this fashion. In this fashion, what happened next? If you remember, if you can remember, sorry, if you can remember, this bank is under the 10% law, okay, which is the design reserve ratio is set equal to 10%. This one is set by the central bank. It is set by the central bank equal 10%. That is the banks here, okay, the bank here should have the reserves, should have the reserve exceed 10% of the deposit. Okay, should have the reserve here exceed 10% of the deposit. What is the deposit of the 10% of the deposit? 100. It should be 10 million, right? 10 million. 10 million. You can multiply 10% with the value of the deposit. It should be 10 million. Now we have reserve equal 20 million, which still exceed 10 million. So this bank follows the law. Okay, this bank follows the law. Okay, now let's move to this bank. When we experience the deposit outflow, we will end up with deposit equal to 90 million. And the reserve now, we have only 10 million left in the pocket of the bank. Okay, what happened next? Because this bank is under the 10% law, okay, require reserve ratio equal 10%. 10% of 90 million is 9 million. Okay, it's 9 million. So in this situation, when we have the deposit outflows of 10 million, banks will have the reserve equal to 10 million, which still exceed 9 million, right? 10 minus 9 equal 1 million. So this bank still have the liquidity. This bank still have the liquidity because it can it can comply, it can keep the value of the reserve comply to the rule of the 10% required reserve ratio. Okay, so in this situation, this bank still have sufficient liquidity. Okay, sufficient liquidity. Now what happened next? Suppose that I just set the reserve equal 0 for this bank. For this one, we have loan equal 90, we have security 10%. This is another bank, okay? This is another bank, which is different from the bank that I talk about, this one. The banks in the next line is a different one, okay? It's a different one from this one. Okay, let's see. For this bank has reserve equal 0. Its loans equal 90, security equal 10. 0 plus 90 plus 10, we have 100 million on the asset side. And how about liability side? We also have deposit equal 90 million. This one is in red ink because it is the value after the deposit outflow. Okay, it is the situation after the deposit outflow, and we have the capital equal 10 million. 90 plus 10 equal 100. So you have the balance sheet of the commercial bank. However, for this bank, if we apply the 10% reserve ratio, what happens? Bank in this situation should have reserve equal 9 million. Okay, it should have reserve equal 9 million. But now it has reserve equal 0 million. In this situation, we have insufficient reserve. So in this situation, banks has the liquidity problem. How? Imagine that there is one person, another person, just withdraw the money here, 10 million, what happened? Deposit will go down to 80 million, okay? And what next for this one? We have a problem because the asset size of this bank are in the forms of loans, which we cannot change anything. And they are also in the forms of the securities, which we cannot sell or resell it. Now, so banks in this situation has a problem called the liquidity problem. Banks have bank in this situation has no money to pay. Bank in this situation has no money to pay for the depositor who would like to withdraw the money. This is the situation called the liquidity problem. Now we will turn to the techniques that we can use to overcome the liquidity problem. Okay, let's see. The first measure that this bank can use is to borrow from other banks. Let's see. For this one, you can see that you should take a look at the previous slide, okay? And now you can compare the previous slide with this one. As you can see from the previous slides, this bank has a problem because banks have to have the reserve equal 9 million, okay? Because in order to comply with the required reserve ratio, which is equal 10%, the banks has to have the reserve equal 9 million, okay? Because it is 10% of deposit, which is 90 million. 10% of 9 million is equal to 9 million. In order to solve the situations of the liquidity problem, banks can borrow from its friends. Okay? When I talk about friends of the bank, I mean other banks. So, bank in this situation can borrow from other banks with the values equal to 9 million. Okay? So, this item will pop up onto the liability side, which is borrowing from other banks equal 9 million, right? In order to balance both sides of the balance sheet, you can see that on the asset side, we will have previously we have reserve equal 0, right? But for this one, when this item pop up on the liability side, the value will go to the reserve, which is 9 million. Okay, the problem is now solved by borrowing from friends, which are the banks. Okay, what is the cost of this measure? The cost of this policy or the cost of this measure is the interest rate on loan. What is the loan? What is the loan in this situation? This one. Because banks borrow this amount of the amount of money here, banks borrow of 9 million here from other banks. So bank has to pay the interest rate to other banks. That is the cost of this measure, which is the interest rate. Okay, the interest rate. In fact, this is the measure that we use to overcome the liquidity problem. But in realities, normal bank in Thailand, commercial banks always keep the value of the reserve in check, so it is unlikely to to have this problem in the real world. But when we talk about the borrowing from other banks, um, banks always engage in this transaction. We call it the interbank lending. Okay, the interbank lending, and it will have the interest rate that will be charged on the interbank lendings. And banks engage in the interbank lendings on a daily basis. Okay, on a daily basis, in order to finance maybe like a short-term working capitals, for example. Okay. Now let's move on to the next one. Okay, this one. We can borrow from the bank, but for this bank, it is not a normal or typical bank. It is the central bank. Central bank is the lender of last resort. Okay, the lenders of last resort. It is the banks for commercial banks. It is a bank for commercial banks. When commercial banks um, have the liquidity problems, they can borrow money from the central bank too. Okay, when you write down into the balance sheet, you will see that we will have this item pop up on your liability side, which is the borrowing from Bank of Thailand or borrowing from central bank. Previously, the items here on the liability side is the borrowing from other banks. So you just replace other bank to the central bank, which is the Bank of Thailand in our context. Okay, our context. And what happened to the asset size, the value of the asset size of the commercial bank? You will see that the value that come up here will come up here in the on the reserves. Okay, reserve will increase by 9 million. Okay, there are two costs incurred in this measure. The first one, which I call the implicit cost, is the bank rate. Okay, is the bank rate. The central bank charge the interest rate on this loan, and the commercial banks, this bank, have to pay the interest rate to the central bank. Okay. Sometimes we call this, sorry, it is not sometimes, it is all the time. We call this the discount rate. Okay, the discount rate. It is the bank, sorry, it is the rate that the central bank charge from the commercial bank. But you can call it bank rate, but you have to make sure that you know that this bank rate you have to pay to the central bank. Okay. Next one is the implicit cost. Can you tell me what is the implicit cost of this measure? I ask every class that I teach this one. What is the implicit cost of this measure? The implicit cost. What is the implicit cost? The reason why always what's that called, because I'm gonna give you the Kahoot. We will check whether you understand the asymmetric information or not. So I will leave 5 minutes for the Kahoot. So can you tell me now, what is the implicit cost of this measure? Any idea, please? The implicit cost. It seems to me that today is not a good day for studying. What is the implicit cost of the channel? When you borrow from the central bank? Okay, I will let you know about this one next class. Okay, so for this one you should think, and for the next class I will start by asking this question. Now let's move to Kahoot. Oops. Okay, let's see whether you understand the asymmetric information or not. Oops, what happened? It seemed to me that not only student but also the internet has a problem. Okay, okay. Loading peak. We cannot loading peak. What happened? Uh, what happened? Okay, anyway, it seems to me that we have the problem with the internet too. Okay, this is the pin of the Kahoot. Could you please sign into the Kahoot here? 4123170, please. Wait. I think I should let this go. Okay, please, hurry up. We have only 5 minutes. You should be hurry up because we have 5 minutes left. 1, 2, 3, 4. I think I should kick these guys out of this carpool. Okay, now I think we have 21 students now. Can I start now? Can I start now? Okay, I will start. This is the question. The reduction in transaction cost per dollar. So we will understand. 3, 2, 1. That's all. Okay. We call this one economy of scale. The reduction in the cost per transaction per dollar as the size increase. Okay. This is pretty straightforward. We also have this guy, one guy, and we have the economy of trade. No, okay. In fact, I expect 100% of you guys can answer this question. Let's see. N. Okay. Who is N? Kick him out. Okay. Now let's go next for the next question. Okay, you can read. I will read for you. When bad drivers lines up to purchase collision insurance, automobile insurers are subject to the when bad drivers are equivalent to our bad credit risk, right? Bad credit risk takers. So the bad drivers lines up in front of the insurance company to buy the insurance from the automobile. So this one is an adverse selection because people who are really reckless tend to seek for the insurance. Okay, so this one occurs before the transaction, so that's why it's going to be the adverse selection. So this guy we have seek for the moral hazard. You should be noted that this transaction occur before. This situation occur before the transaction. N. Oh no. Okay, next. Okay, everybody. Okay. For this one, you can see that we have the keyword. We have the keyword incentive, right? Incentive. For this one, it means that we have two parties. One party has the incentive to do something that is not in the same interest or that is not in the same objective of another party. So for this one is the moral hazard. Okay, moral hazard. You guys know about moral hazard, right? The manager tend to do something that is more risky. So the stockholder don't like that one. Okay, this one is the deviate from the objective. Now let's see. Jing. Oops. Okay. Good. Number 4. Benefit of financial intermediaries. This one I think should be 100%. You have 6 people here. Why? How come? How come you have 6 people here? This one all correct. As you know, when we have the financial intermediaries, everything here is the benefit. Okay. Frame. This is about how quickly you can put how you can type your answers. Okay, now let's move on to the next question. Lemons, problem. 100%. Lemons problem is an examples of adverse selection, not free rider, not moral hazard. Okay? Taking other hypothesis is something that is not relevant to this one. Okay, let's go next. Frame. Now, we have a blank and you need to put some word into that blank. This one is taken directly from your slides. So for this one, we have the free rider, right? We have the free rider in the situation. That is why the private production and sale of information cannot fully eliminate adverse selection. Okay. However, for this one, free riders also arise in the context of the information too. But for the moral hazard, it should be monitoring, not the private production and sale of information. Okay, it should be the monitoring. We also have here principal agents. Principal agents problem helps to explain why. No, I think this one is not relevant. This one is not relevant. If you chose choice the green one here, I think you have to read the slides again because principal agent is something about the moral hazard. Okay, let's see. Okay, next one. Government regulation require publicly traded firm to provide information reducing what? Okay. Okay. Calm down, calm down. Everyone calm down. Okay. This one, in fact, it can be used to reduce the degree of the adverse selection or moral hazard. In fact, for this one, I just took this problem, I just took this exercise from the Michigan, and Michigan give the solutions as the all of the above, but I think this one is incorrect. Okay, the correct one should be the adverse selection because it is likely to be the results of this one is more clear. Is more clear rather than the transaction cost, rather than the need for diversification. Okay, this one should be the adverse selection. Sorry for 23 guys here. Okay, let's see. Next, deposit lacks of information about the qualities of bank assets can lead to what? This one, I think I didn't talk about this in class. Okay, folks, listen to me. We just have, I think we just, we should, I should let you go now, but anyway, let me explain this one. Asset transformation is the core business of the commercial bank, okay? The bank just transform the short-term asset to the long-term asset, right? It is the short-term liability, but it is the asset for the depositors. So this one is not relevant to the information. For this one, if depositors if the depositors are lacking of information of the bank, or if the depositors face the uncertainties about the balance sheet of the bank, we will have the bank panics. Sometimes we call it bank run. Okay, bank run. Because people will line up in front of the bank and withdraw the money, right? Okay. Next. Because of asymmetric information, the failures of one bank is okay, bank run. This is the one. The failure of one bank can lead to runs on other banks. It is like COVID-19. So this one is a contagious effect. This one I didn't talk in the classroom, but it should be the basic vocabulary that you should be familiar with. Okay? Okay. The last one, maybe the most important one. Moral hazard is an important concern of insurance because of the existence of insurance. Wait, create another person. Increase. Sorry for this chat. Sorry. Provide increase incentive for risk share, so risk taking. Okay, let's see. Podium. Level 3. Okay. I will give you the solutions and I will give you the list in the TU model. It will be recorded in form of the Excel. Okay, see you in class. Thank you very much. ขอบคุณนะครับ บ๊ายบาย เดี๋ยวผมโพสต์ในยูทูบแต่ว่าเดี๋ยวแต่นะมันไม่ใช่คุณเข้าผิดนะอันนี้มันมีเป็นของคุณมีเข้าไปในเฟซบุ๊กได้คุณมีถามเพื่อนดูผมจำได้มันต้องเข้าซึ่งมันจะมีลิงก์เข้าไปดูได้เนี่ยจะโพสต์ยังไงผมโพสต์ให้